I understand that you want to get the message out there as a communication piece that the rates, the Fed won't raise rates this year, and this is what you've been talking about. But presumably you would be open to the data changing your mind. I'm just wondering what in the data would bring you into that sort of mid-2015.
So that's not actually the message I'm trying to get out, so I've failed yet again in communicating. The message I'm trying to get out is that because the 1 to 2 year ahead outlook for inflation is as low as it is, and will remain as low as it is through 2015, we should not be raising rates. That's the message that I'm trying to deliver. Now, what shapes my outlook for inflation? Why do I think inflation is going to be as low as it is going forward? The fact that inflation's been as low as it has for such a long time, I think makes it harder to move inflation up. But if I were to start to see persistent movements of core inflation back towards target, that would be good. If I were to start to see some of the inflation break-even measures, the market-based measures of inflation expectations I referred to in my talk, move back up, that would be good. Start to see some wage pressures, that is employment costs, hourly earnings, average hourly earnings, growing more rapidly than we've seen it in the past. All these things would start to build a story for me that, yeah, inflation's going to be, I should be revising my inflation outlook upward. And then I would start to be thinking about, well, maybe this is the right time to be raising rates. But I have to start to see some of those things.
So most of your talk, and you mentioned it again, is the focus on inflation. But can you give us an idea of how you view the outlook in employment with the unemployment rate going down? And just to clarify on that, what do you think the long-term natural rate of unemployment is right now?
Well, I'll answer that second question first about the long-term natural rate of unemployment. My estimate right now is about 5%, but I have to say that I'm concerned by the fact that it's moved as much as it has in the past 2 years. It's certainly come down quite markedly in the past 2 years, and the fact that we've seen such modest wage pressures, given at the rate of unemployment we are seeing right now. It's something it's not something I would do on the fly or anything like that, but it's something I would have to think about again. Maybe the natural rate of employment is even lower than the 5% I just cited to you. I'm sorry, what was the first part of your question, Karen? It was employment. How do I think about employment in terms of? Yeah, I don't think that the max employment mandate should ever be should be in and of itself be a reason to raise rates. So what I mean by that is that I think promoting max employment means that we're supposed to be taking actions to promote employment, promote higher employment, as long as that's not causing costs or risks somewhere else. So where could those costs or risks materialize? I emphasized inflation. I don't think there's any, maintaining an accommodative stance is not seem to be generating inflationary pressures. The other cost that people talk about, and I've talked about in the past, is potential cost of financial stability, so risks of financial stability. And I continue to monitor those very carefully. Our staff around the system does a great job on that. And I just don't see those as being material at this point to the outlook for monetary policy. But a decline in unemployment in and of itself should not be a reason to tighten monetary policy unless, and I say in and of itself, meaning unless it's feeding through into inflationary pressures in some way. Yeah, Steve.
Chair Yellen emphasized in her press conference, she seemed to be suggesting that there was an FOMC consensus that if the FOMC could become confident in its inflation forecasts, that would be a reason to lift off, that you wouldn't necessarily have to wait for inflation to get back up, but if you could be confident you were headed there, that would be okay. Do you share that standard for monetary policy? And if so, you mentioned earlier a number of things that would be good to see. Are those the kind of things in your mind that would build that kind of confidence? Or do you have a different standard?
So I've suggested in the past, and I wouldn't deviate from this, that I think we want to see our 1 to 2 year ahead outlook for inflation back to 2%. What I was trying to indicate my answer to Jonathan was, what are the ingredients that start to build that outlook for you? For me, it's not enough to say that boy, inflation looks. I have some confidence inflation is starting to move back toward 2. My own the standard I've been using and I've articulated in the past is that I want to see that 1 to 2 year outlook for inflation back to 2%. Yeah,
Given that oil is likely to cause havoc in headline inflation readings, perhaps for all of 2015, should we be watching headline or core prices as we move forward?
So headlines, the variable that we care about in terms of hitting our 2% target. But the variable I try to use to forecast where headline's going to go is core. So that's why I watch core. It's not because I care about core intrinsically. It's because core is helping me forecast where headline's going to go. And that's always true, and it's probably going to be especially true in 2015 that you want to be watching core as a guide to where you think inflation is going to be going in the future, much more than headline. We just had a year like this, of course, in 2008, where sort of, I guess, maybe on the flip side, right, where oil prices shot upwards, headline inflation got to be near 4%. Or over 4%, but that would not have been a good guide to where headline was going to go in the remainder of 2008. And core has its deficiencies, but it was better. And one of the pictures I showed today showed what core is like a smooth version of headline, right? You see it wiggles around. The blue line was headline, was wiggling around core. So core is just picking up more of the impulse of where inflation is going to be going.
Do you ever watch any of those trim to mean type of inflation?
I think those I do watch those. I think those usually tell, I have found, at least from my own experience, those tell a similar story what's going on in core. But there's a question back there, yeah.
Yeah, Shane Farrow from Business Insider.
Hi.
You talked a lot in your speech about how employment has really improved in the last year, and this also coincides with the tapering of QE, and I'm wondering if you see any connection.
No. In fact, I think that the story I was telling in my speech was that we might have seen a more rapid increase in employment, a more rapid improvement in labor market conditions had the tapering been slower had the tightening of monetary policy not been as pronounced in 2013, or 2014, I should say. But your question is a great illustration of the challenges in macroeconomics, that many shocks are hitting the economy at various points in time. And you can't just, you always have to stop yourself, and I have to do this myself all the time, of just looking at correlations, co-movements, and variables. We know, but you have to know the theoretical force of what's driving it. And here, monetary stimulus, we have confidence, will generate higher prices and generate higher employment. And if we take back monetary stimulus, we're going in the opposite direction. Last year was a great year. I think there are a number of, the committee took note of the fact that there was less fiscal drag, for example, in 2014. That's a good thing, and that's going to help push the economy in a good direction. The fall in oil prices that we just talked about is another form of stimulus that will actually push upward on employment. So all these things are I think, the reasons why we saw such a marked improvement in employment. But I would say it was despite the taper, not because of the taper.
This summer in Minneapolis, you talked a bit about how policymakers and business leaders need to sort of push back against this notion of a new normal. And then at the same time, you're talking now about how it seems like markets are, sort of buying into that a lot. So what can you sort of do? What are you doing as a policymaker to push back on that?
I think what I would try to do is to say that there's more we can do. We shouldn't be satisfied with where we're at. The fact that the employment to population ratio has gotten above 59%, that shouldn't be enough for us necessarily. What should be the signal on that is what's going on in prices. As long as inflation is as low as it is, we have more work that we can do as monetary policymakers to help on the real side of the economy, to help on employment. So that's what I try to do. They don't let monetary policymakers do much more than monetary policy, quite rightly. And so my argument is, in terms of the monetary policy, is, look, don't be, this argument of the new normal actually had more resonance over up until the end of 2013, where you look at that ratio, the employment to population ratio, for example, it remained pretty stable. It looked like, boy, you could never get above 59 again. Hey, we just got above 59. So there looks like there's more we can do on this. And you knew that even if you just looked at the inflation data. So that's the message I would send is, don't be satisfied with some modest amount of improvement in employment. We can do more, and we know we can do more because inflation is as low as it is. Yeah.
Alex Rosenberg from CNBC. Maybe coming off of that a little bit, I hope this isn't too far afield, but I know an earlier piece of research you did on land prices was used in a paper about actually trying to model secular stagnation, given different ages. And I guess, I wonder if that's something that you're maybe concerned about, or do you think, how you respond to those kinds of concerns?
I think these are risks that are out there. This is absolutely not my modal outlook by any means, but there are risks that growth could turn out to be low. Real interest rates could turn out to be persistently low, low enough that it's hard for monetary policy to provide the requisite amount of accommodation. But I think a secular stagnation is a risk we should be thinking about as monetary policymakers. It's not by no means my modal outlook at this stage. I think she hadn't asked a question yet.
Hi, Samantha Scharf from Forbes. You mentioned that your long-run view of the unemployment rate is that it should be around 5%, but that factors could change that. I wonder if you could elaborate a little bit on what goes into that current view and what could change it, and also if we should still be using this measure given all its flaws. If the unemployment rate is still what we should be focusing on.
Oh, well, that is a good question. I mean, I think that, given how much my long-run estimate of the long-run unemployment rate consistent with 2% inflation has changed, that there are reasons to think about other things. I think the reason we use the unemployment rate is I use it, to be more precise, is it is the metric that most Americans understand most clearly. And so I think that is a good reason to. All these other metrics that I talk about with the labor market, and they all matter, but they don't have quite the same resonance for most people I talk to as the unemployment rate. That's the one they're most familiar with, and that is a powerful reason to stick to it. One of the things I look at in terms of the unemployment rate, we're doing a ton of work all the time in the system, and about what we think that long-run natural rate of unemployment is going to be in the long run. It's tough work, it's hard work, but I would say for myself, a key variable is looking at what's happening with wage pressures. So just in the past, but also we do a lot of talking to business leaders and to labor leaders about where they see wages going. And those conversations are also very influential. As long as that remains low, boy, it's hard to see how monetary policy pushing and trying to stimulate demand is going to generate undue inflation. Yeah.
Is there an employment to population ratio that you're looking for generally?
No, I would. The short answer is no, and in fact, I'm gratified at how high I got. I mean, I actually, if you'd gone back 3 years, I would have said that, boy, I don't know if we'll get back to 59%. So I'm very happy with where we've gotten. I think, so this gets back to this question about the unemployment rate. I think it's easier, as a monetary policy maker, there's lots of long-term influences on the employment to population ratio, like the demographic forces I talked about earlier. So that you can't target that. But all I'm saying about the employment to population ratio is that this is something that's good to have higher if we can do it without having undue inflation. And as long as inflation remains low, as low as it is, and our outlook for inflation remains as low as it is, there's room to do more on that front. Jonathan, you had a question, at least one more question.
If we can take a step further, this yield curve idea, you were asked downstairs, whether you should base policy on bond market reactions. You said no, unless it affects the economy. Given what we have now, with the flat curve and this sort of puzzle around it, what is the risk as a reaction on a reaction level to lift off, if we were to lift off in this situation?
Yeah, I would say I'm still thinking that through, but I don't think of the market reaction risk is the most material risk that I worry about. What I worry about is the credibility risk with liftoff. That is, that if the markets and the public see the Fed lifting off when our outlook for inflation is as low, when inflationary pressures seem to be as subdued as they are, then I think that's going to be another ingredient into the public's losing confidence in the Fed actually pursuing 2% inflation, actually, and the markets seeing the Fed pursuing 2% inflation. So it's less about rapid corrections in markets, but more, whenever we take an action, whenever we make a communication, that's the market and the public are thinking about that in terms of what does this mean about what the Fed's really trying to do with the macroeconomy? And if we lift off during the course of 2015 with inflationary pressures as low as they are, to be clear, then I worry about that credibility factor. Sure.
Given that you don't necessarily agree with your colleagues on the timing of rate increases, how do you feel about the confidence of the tools that the Fed has right now and our testing with the overnight repo and stuff? How confident are you that they'll be able to lift rates efficiently?
I have every confidence in that. That's not a source of concern for me at all. The issue for us is the usual one. It's not. There's nothing new for us on that. It's the usual one. Is when do we take the step to begin to tighten policy in light of the macroeconomic goals that we're trying to achieve.
Do you have a forecast for how you expect wages to evolve over the next year? Some of your other colleagues have said it's going to be a swing factor, and it's very important what happens there over the next 6 months in terms of building confidence in the inflation outlook.
We're starting to see a little bit of increase in wages, but I'm anticipating that wage growth will remain quite low. So,
Why is that?
I think that there's a number of factors that are going into that. I do think that the story, there's a couple of different issues. I think one is that slack actually remains relatively high despite the low unemployment rate. You have the large number of people who are part-time still looking for extra hours. That pushes downward on wages. I think I'm more optimistic about the people who have quote unquote left the workforce, that they are also putting implicit downward pressure on wages because they could come back in. And I think the final piece is really about inflation expectations. That's a key piece of what goes into making wages. And if those are low, then wage growth is going to be low. So there's this feedback back and forth between wages and inflation expectations as well.